the Trump administration's bold move against China's financial power. In a move that has left many reeling, the Trump administration has made a decision so bold, so unexpected, that it's causing ripples across the global financial system. The U.S. Treasury, under Secretary Scott Bessent, has demanded that the Asian Development Bank, ADB, one of the largest multilateral financial institutions in the world, immediately stop lending money to China. That's right. Washington is making an all-out push to sever China's access to critical development loans. Now, why would the U.S. go this far? It's because China has been using these loans to fuel its influence across the world. For years, China has been strategically deploying funds, often at lower interest rates than what it would face through its own domestic banks, to build infrastructure and invest in developing countries. By doing so, it has expanded its power, forming relationships and alliances in places where the U.S. once held a strong grip. But with the world in financial turmoil, Washington is playing its last card. In essence, the Trump administration is pulling the financial emergency lever, hoping to choke off the lifeline that's been fueling China's global ambitions. This is a direct attack on China's ability to grow its influence using cheap loans. Behind closed doors, the White House is panicking. The U.S. dollar is under pressure, inflation is rising, and China is tightening its grip on global trade. For the Trump administration, this is no longer about diplomacy, it's about survival. The U.S. bond market crisis and the Trump administration's economic gamble. The root of America's panic lies in the faltering U.S. bond market. For decades, U.S. Treasury bonds were seen as the gold standard, the safest bet in global finance. But now things are changing. As interest rates climb and the U.S. government's debt continues to grow at an unsustainable pace, investors are starting to question the reliability of U.S. debt. In fact, Treasury bond yields recently spiked, and for the first time in a long while, the world is starting to look at U.S. debt with a more skeptical eye. This is a monumental shift. For years, the U.S. had relied on issuing debt to fund its activities. But now, as foreign buyers begin to back away, the costs of borrowing are rising, putting the government in a precarious position. Worse still, with the Federal Reserve raising interest rates to combat inflation, the government is facing higher borrowing costs at a time when it needs more funds than ever to cover its deficits. But here's where it gets really interesting. While the U.S. bond market is struggling, China's bond market is thriving. Yields on Chinese government bonds are incredibly low, meaning China can borrow money at far cheaper rates than the U.S. This stark contrast between the two economies is a sign of China's growing financial stability, something the Trump administration never anticipated. Trump's strategy, tariffs, tax cuts, and an increasingly tense financial war. Donald Trump has long believed that tariffs are the way to level the playing field with China. In 2018, the Trump administration implemented some of the most aggressive tariffs the world had seen in decades, raising import taxes on over $600 billion worth of Chinese goods. Some products faced tariffs as high as 145%. The idea behind this move was simple: hurt China economically and force American companies to bring their factories back to the U.S. However, instead of causing a downturn in China's economy, the tariffs ended up backfiring. The global financial markets were thrown into turmoil. U.S. government bond yields spiked, and foreign investors began pulling back, concerned about the stability of the U.S. economy. For years, U.S. Treasury bonds had been the safe bet in global finance. But suddenly, that trust was beginning to erode. Trump's hope was that tariffs would lead to a resurgence of American manufacturing. By making Chinese goods more expensive, he believed U.S. companies would bring their production back to America. But as we're seeing, economic realities are far more complicated. The truth is hard to ignore. You can't win a global trade war if your own economy starts to fall apart in the process. After tariffs failed to produce the desired results, Trump moved to his Plan B, massive corporate tax cuts. In 2017, his administration slashed the corporate tax rate from 35% to 21%. But Trump didn't stop there. He now wants to lower it even further to 15%, in hopes of spurring economic growth and attracting more businesses to the U.S. On paper, these tax cuts might look like a good deal. Cheaper taxes mean more money for businesses to reinvest in hiring, building factories, and growing the economy. Companies like Tesla and Foxconn even started talking about increasing their investments in the U.S. But there's a huge catch. These tax cuts could cost the U.S. government nearly $9 trillion over the next decade, about $900 billion every year in lost revenue. And how is the government supposed to make up for this massive shortfall? You guessed it, more borrowing. But here's where the real problem begins. Investors aren't as eager to buy U.S. debt as they used to be. And if they do, they're demanding higher interest rates, which makes borrowing even more expensive for the U.S. government. This sets off a dangerous cycle. More debt means higher borrowing costs, which means even more debt down the line. China's growing economic power. A rising threat to U.S. dominance. While the U.S. economy struggles with debt and inflation, China has been quietly building economic power. Despite the ongoing trade war, China's economy remains strong and resilient. One key factor is that China has access to extremely low borrowing costs, which gives it a massive advantage over the U.S. This allows China to finance massive infrastructure projects, invest in new technologies, and continue to grow its influence in emerging markets, without the same burden of rising debt that the U.S. is facing. For example, as U.S. investors pull back from U.S. Treasuries, many are turning to Chinese bonds, attracted by their lower yields and greater stability. In fact, the yields on 10-year Chinese government bonds recently fell below 1.7%, even lower than Japan's bonds. That's an astonishingly low rate, which means China can borrow money more cheaply than the U.S. right now. How did this happen? The simple answer is trust. Even though China is involved in a trade war with the U.S., investors see it as a safer, more reliable place to invest. The Chinese government quickly reassured markets, issued long-term bonds, and directed funds into large-scale infrastructure and energy projects. This has made China an attractive destination for global capital, shifting the economic balance away from the U.S.-China's strategic use of multilateral banks. A financial backdoor. One of the most important tools China has used to expand its influence is the Asian Development Bank, ADB, a multilateral financial institution that funds infrastructure projects across Asia. The U.S. and other Western countries have funded the ADB, but China has been using this money to build its empire. Here's the kicker. China is both a donor and a borrower at the ADB, meaning it helps fund the bank with one hand and then takes loans from it with the other. This dual role allows China to use ADB funds to finance projects in developing countries, often at lower interest rates than what it would get from its own banks. But here's where it gets even more interesting. China borrows money cheaply from the ADB and then lends it to other countries at higher interest rates, making a profit in the process. This strategy has raised alarm bells in Washington. China isn't just using brute force to expand its global influence. It's using a clever financial trick that the U.S. helped fund. The U.S. wants to stop China from continuing this tactic, but doing so could damage the reputation of the ADB and create a diplomatic nightmare. The U.S. dilemma: fighting a losing battle in a changing world. So here's where we are. The U.S. is stuck between a rock and a hard place. On one side, China is gaining ground, using its financial power and influence to extend its reach globally. On the other side, the U.S. is struggling with rising debt, rising interest rates, and a loss of investor confidence. Trump's economic policies, while meant to strengthen America, have made it harder to win the global financial battle. And as China continues to play its cards well, the U.S. risks losing its grip on the global economy. The question is no longer whether America can win the next trade war. It's about whether the U.S. can afford to keep fighting abroad while its financial system begins to falter at home. If you're finding this breakdown interesting and want to stay updated on the latest developments, make sure to hit that subscribe button. We've got plenty more insights and deep dives coming your way. Don't miss out. Subscribe now for more.